Welcome to TradeTheMBA.com. This is John. This report is for the 16th, and well, there you can see it finally took place. I had talked about this. Gosh, we would have to reduce this chart so far back. I don't even know if it's possible. We were well below into the 1600 range. Talking about this, it would be well over a year plus ago. We were dipping down here. And I was calling for 2350, calling for other benchmarks like 2150 as well, interim, and then we had like the 1900 and a couple of others in between there. And so many, it's not even naysayers, they just really misread where the economic cycle is, and it's a real problem because there's so much of this disinformation, really. Everyone now talks about fake news. Well, there's so much of that goes on with the markets that it's really shocking because unless you really have a broad macroeconomic understanding of how things really function, and some of that being not just academic, you actually have got to have a practical understanding of what it is to actually understand the dynamics between what moves an economy and how things get going. And interestingly enough, I would say that Trump on the beginning of his term has got the right angle. First is optimism, a belief that things are going to improve, because at that stage, people want to get ahead of it. They want to be front-loading it. So you'll get that group that then goes in, and then the other people will say, well, I want to wait and see. And then those people see the other people jumping in. They say, well, now I'm starting to see something. They get involved. And so by the time your ultimate naysayers who are, the world is ending, the market will be, we're going to get to 2680, and then we're going to also be moving towards the 3,000. There's no question about that. This was the same when I was talking about Dow 30,000 long before you just recently saw those articles. I have to dig back. Can you imagine going back through all of my videos from all those years ago and pulling it up? But I'm sure someone has. But it's not relevant. It's mostly to point out, though, that for the last decade, we've been spot on in knowing where this market is moving to and how it's been seen by the real players. Everyone seems to believe that there's this mass collective that really decides where price goes, and I've always disputed that. I've always told you that I don't believe it. I've always said to you that there is a small fraction of the market that is really controlled by most of the money. And some of it is what you might call smart money. Other parts of it are just following money. But because it is so much money, they get to decide, and the rest don't. That's just the way this setup is, and it belongs to a few big banks and some of their arbitrage, if you want to call it that. I mean, a lot of them talk about hedge funds not doing so poorly in that. Well, I think some of this is a misnomer. These banks and things are reporting some pretty impressive numbers. This went all the way along with the strategy from convincing everyone on TARP that, the moral hazard of trying to help homeowners stay in their homes. It was easier to foreclose on, 3.5-4 million people than it was to, just give a little bit of assistance to them. Fine, those are political decisions, but it certainly shaped how banks saw that they could take advantage of the situation. And, we had that stagnation period right afterwards where it was safer for them to lend to the federal government than to lend to individuals for business activity. And that's only now starting to change. Obviously, cheap money meant that corporations, though, could issue their own paper for ridiculously low amounts. And so coming out of this near decade of no growth policies is going to be a very dynamic tussle, and I don't think people fully understand it yet. It's going to be a lot of displacement, and then secondarily you have the technological revolution that is about to take place in automation, and how that's absorbed by individuals and what protections are provided are going to be very interesting dynamics going into this economy, and whether or not you're going to allow specific businesses to become literally monopolies. I mean, in some cases they already exist, and I think Trump has identified a few of them. And that's fine. Those are all political discussions. It's not going to change the fact that perceptions towards the positivity of economic growth are continuing. And while I'm giving you this diatribe, it's important because I haven't been wrong in any of these assessments over the years, and it's worth taking that into account when you look at the broader understanding of what it is we try to do in parsing market segments and understanding that no, not all two portions of a market are the same. Even though the candles may look identical, you may see similar readings from certain oscillators, but no, they have different impacts and they have different meanings. Now, obviously, this euro situation, we saw the market started trailing lower early as we broke down below my little support line right there. And sure enough, that caused central banks to step in. And as soon as they stepped in, the market felt very comfortable behind that backstop of the Fed. Well, we assume it's the Fed. We don't know, but I think it's safe one to call out. And regardless, whatever the support was, it always happens at the same spot, and that caused the market to rally and reach that magic 2350 that I've been calling for. This also meant that, this discussion I have of, bonds heading, or TLT at least, heading down to the 113 started to make its move. I think that it'll be interesting to see the combative nature between Yellen and Trump when they start to raise rates, and they're going to have to more aggressively, because as you pull out of this no growth situation, then we have to talk about that deficit and what that really does to capital and what will happen to an ever squeezing budget. That doesn't even take into account tax revenue and dealing with theoretic tax cuts. Oil, still stuck at that stagnation. Now, oil's going to start to have to push higher if there starts to get to be real news that there's activity. Gold, as I said, is going to rise, so there's no question about that. Just as a function of rates, Yellen is already broadcasting it. She's pretty much telling you that you can look for 125 on GLD without even blinking. I don't know that other people necessarily are saying that, but they should be. But I know some people have some astronomical claims here and there. But I try to keep it practical for you in segmented steps. The 5K chart, there's not even anything to talk about. It was just straight up following the ABM. And it has been all the way from that breakout period. We had this little soft, chunky area, and we knew that from there it was going to go. And there you have it. So didn't mean to run off at the mouth, but it was worth pointing out some of these details at such a monumental figure. It's taken a little while to get here, but that's okay. There was never any objection about how long it was going to take. It was just an understanding that we could see where the dynamics were pulling things. And we can get into some of the calculations to go into that another time. As always, though, could you look for me on the Skype chat? Trade well.